Hey guys.
Chris, Cam, how are you?
Great. April 23. It's flown past, hasn't it?
Scarily
4 months
flown
into the
past.
year. So yeah, look guys, we're obviously here to do our April 23 monthly market economic update. It's obviously been a little bit happening in markets, and we're keen to obviously chat through some of that today. Okay, so just working our way through this. All right, Chris, GDP growth numbers.
So
talk us through this one.
Well, obviously, charts showing up there for everybody to see that we're kind of flatlining, which is good. We're not obviously going through where we were over the last 2 years or so, where it's been a wild ride both up and down. It's nice to see something more along the lines of normality coming through, if you can call what we're currently going through normal. But nice to see, I guess stability is probably the word that's becoming a bit more apparent in trend.
Yeah, and I think obviously, we always talk about it, but you can see the significant down in COVID and the significant up post-COVID, but normalising is good. Also, almost back to where we were in the mid-2000s, through the 2010 to 2020 period. So that's obviously a good thing. Yeah, that's around the world.
It sort of tells a slightly different story to what we hear regularly, isn't it? We hear on the news and the like that the GDP is suffering or the economy's falling, but these numbers are perhaps showing at the moment we're stabilising for the time being.
Yeah, that's right. Similar story in Australia. Yeah. So obviously there a few more spikes, but we're normalising back to that 3% mark, 3 to 4% mark, which is excellent. Inflation, Shane.
Yeah, well, it's been the headline, hasn't it, for quite some time, and we're all feeling it every single day, inflation. But pleasingly, we're starting to see a small trend down, which has been probably not noticing yet from day-to-day point of view. No. But the numbers are speaking to that a little bit, and of course we saw the Reserve Bank sit on their hands this month, which probably speaks a little bit to the fact that inflation's coming off here in Australia, and I'm sure we'll see in a moment inflation around the world is probably, we're lagging a little bit on that front.
Yeah, but the inflation numbers around the world, which as evidenced here, really have started to turn around. So increasing interest rates, less money in the system's really starting to have an impact on what the cost of things are, right?
Oh, most definitely. And this is the whole thought process now for the central banks of the world is to try and get this inflationary number back to some sort of the normal range here in Australia, 2 to 3%. And if we can do that, perhaps they'd be quite happy with what we've seen with interest rates rising. And who knows, we might see them reverse at some point in the next 12 months.
Yeah, be interesting to see the trajectory on that as to how long that takes in terms of are we looking at 12 months or are we looking at years? In terms of there's some reports out there about it being stickier than we expect, and then the next day you hear a report that it's coming off quickly, and it's definitely a lot of conflicting views out there. And so I guess it's just going to be interesting as we move forward through time, continually doing these to see what the trajectory of that is.
So what's the impact on financial markets, do you think?
In terms of either of those two scenarios? Yeah, I think if we have a really sharp drop down, I think the impact is there will be a lot of fear around it being they've gone too far too quickly, and therefore inflation's unwinding really rapidly. We're headed for deep recession, and subsequently that's going to mean financial markets would plummet. But conversely, if we have something that is a little slower, we're probably likely to see financial markets stabilise and probably improve through time. I guess the other risk is that it doesn't come down, and then we've just got increased uncertainty for longer, which is never a good thing for financial markets. Nobody likes uncertainty on that front.
Okay, so wages and unemployment. This is peculiar to Australia. Shane, do you want to walk us through some of this?
Yeah, well, I think there's a common theme in some of these slides thus far with GDP into inflation, and you look at wage price index growth, and it's certainly trending up. And that's a great thing really for people who are needing to support themselves with increased cost of living. Yeah. But it is also the dichotomy of it's the enemy in the reserve bank size,
Correct.
because the more we have wage price increase, the likelihood of inflation staying high will be there, or the interest rate cycle staying high will probably be more likely. So it's a bit of a fine line depending which way you look at it, I think, in this one. But I must say, seeing some wages growth is probably a nice thing, given that chart there we're seeing for such a long period of time.
Yeah.
Wages growth, trending down.
It's just so incredibly low for such a long time, wasn't it?
Yeah. So, perhaps this whole cycle is a normalisation or a renormalisation, if you will, of many things that have perhaps been a bit out of kilter for a while.
It's definitely been out of kilter. That's absolutely.
Okay, so this chart's a really interesting one for me, the consumer sentiment numbers. Importantly, it's only one view too, right, guys? But importantly, looking here back in GFC type times, this is how people felt. So it's a measure of how people feel.
Yep.
We're at around about just 88, 87, I reckon it was. Peak of COVID is about the same, and now, because we've seen such a rapid increase in interest rates, people are starting to feel it, right?
Yeah, absolutely.
Yeah.
Yeah, and it's not just interest rates as well. I mean, I was having a conversation earlier today and talking about a person who hasn't got any debt, but they too are feeling the pinch with respect to energy prices, fuel prices, the cost of groceries and the like.
Yeah.
So, the interest rates are impacting mortgage holders, but there's also that inflationary pressure that contributes to this consumer confidence, which is being felt right across the board, which I'm sure everyone listening today would be certainly feeling that
that's
right now.
The interesting aspect of this too is the consumer is 60% typically of GDP. So
60%
of
Yes.
GDP is
Okay.
consumer expenditure. So if that number is as low as it is, obviously, that's as low as it's been since 2003. That says something about the behaviours of people, how they're spending their money out in I was going to say the world, but out in society.
The thing that I find so fascinating about this, and it's just anecdotally, we all feel this at this point in time, but you still see these numbers coming out where, restaurants are full and, retailers are doing okay. It just, I don't know, I haven't quite seen the knock-on of this. Perhaps there's a bit of a lag to come, but it's certainly, it's hard to read a little bit, I think.
I think also there's 40% of people had fixed home loans. So there was no payment at all.
Yeah.
And then that's now, I reckon we're halfway through that, and I don't know what the number is, but wasn't it supposed to be by July that the majority of the fixed home loans had run out, and then you're going from 2% on your mortgage, a $1 million mortgage,
Yep.
to, say, 20 grand a year in interest.
Yep.
And then you're going up to 5 or 5.5.
Yep.
So 55,000 a year in interest.
It's a big number. It's a big jump.
Yeah, and it comes that's discretionary income, right? So it's
All
coming
spent,
straight out of the
Renovations,
economy. Yeah.
Yeah, it's interesting that, as that plays out through the course of the year, I know I've been having conversations with a relatively reasonable number of new clients who that has been their concern. Coming in saying, I'm coming off fixed rates at the end of the year, what do I do? Yeah, and for some of those, we're looking at a negative cash flow position. And don't know that the reality of that is actually set in for some people, in that it's okay now, but then obviously then you're eating into savings.
Yeah, sustainability.
Yeah, correct.
And then, Australian house prices, household debt, net wealth. I guess the one that we illustrate here typically is house prices have fallen. And the next slide will probably speak to that a little bit more. But also, we are starting to see a reduction in overall net wealth from where we've been, which is followed by a reduction in asset values on dwellings, so houses, and to some smaller extent financial assets. So that's quite interesting, and I suppose the impact on all this around house prices around Australia is pretty well illustrated here. So jumping down to the bottom here, with the last 12 months we've seen Sydney house prices fall 12%. There's also been about a 20% reduction in listings, I think, compared to the same time last year. So Melbourne house prices down 9%. It's a significant number.
It is.
It's a big number, yeah, particularly when you look at the median price of a house.
Which is about
I think it's in that closest to $1 million, in that realm, I think, yeah.
$100,000.
Yeah, and it's particularly pertinent if you bought a house in the last 2 or 3 years.
Yep.
It doesn't help in that regard, of course.
No.
But I mean, that chart on the previous slide where you're sort of seeing the top right-hand corner there, that overall wealth position
Yep.
trending down, it probably speaks a little bit to that. But a lot of that is linked to people's households.
Yep.
And again, when it comes to our homes, I'm never really one to worry too much about what your house is worth if you're not for sale, right?
No.
So it's sort of like there's some of these numbers which, they're real, but the turnover of housing is certainly not, something that we do every day.
No.
That chart that you sent through, I think internally yesterday, that was interesting in terms of like percentage of wealth of percentage of people's wealth that's in property versus.
Well, I didn't see that specific chart. Chris, talk us through it.
I can't remember the specifics, but it was heavily skewed towards real estate being in Australia anyway.
Wow.
The large predominance of wealth comparatively to say super or personal investments. So, I guess what we're looking at, it has a material impact on.
Well, I suppose, just speaking to that, you can see that in the chart here, right?
Yeah.
So this is dwellings, and you can see the reduction. It's almost the same percentage reduction. So
Yeah.
went through that as what we've seen in net wealth. Yeah, it is interesting. All right, so financial markets. How do you guys think financial markets have been responding to what we've seen in terms of inflation starting to come down a little bit, which is what we want to see? GDP normalising off where it's been. What's been happening?
Well, I think from observationally, the fact that we've perhaps got a little bit more stability, and I wouldn't say certainty is the right phrase, but I guess the outlook is a bit clearer than it was maybe this time a year ago when we're right on the edge of inflation rising and that kind of thing. So I guess the upswing from that is markets have settled down quite significantly.
Yeah.
And we're seeing it in numbers, and these charts speak to that. If you look at some of those numbers there, it's sort of rising up, which has been certainly welcome for all investors and the patience of investing, and our nerve gets rattled a little bit at a time when markets are suffering. So
It's been a tough 3 years.
yeah. And it's certainly it feels like a long 3 years now.
Absolutely,
It's almost just over 3 years since COVID began. Yeah. So, but I think, as I said, my observation on it is that a lot of people I've been talking to are kind of the view or that sort of mindset that the markets have been struggling, because that's what we hear consistently on the news. But conversely, with things stabilising, markets have actually been quite okay.
Yeah.
So it's a really pleasing set of numbers up there, I think.
Yeah, it's nice to see some positives, which is good.
Well, this is bond markets specifically. Yeah. So in the last 6 months we've seen bond markets rise. So the two charts there, Vanguard Australian, that's a representation of Australian bonds. So that's up 4.2%, and then this one here is representation of global bonds, which includes US government bonds.
Yep.
And the like. So it's nice to see that. If we have a look through the equity market performance in the last 12 months, so it's essentially been flat. It's interesting, isn't it?
Yeah, after the full, if you think back at the news cycle over the last 12 months, and obviously there's been periods there where it's been really, performance has been quite negative, but it's typical of the media cycle, right, where market falls 4 or 5%, it's the front headline of every newspaper or website you're on, and there's lots of pictures of screaming bears and red and blood on the streets. But then market goes up maybe 5% over the following month, and you barely hear a peep type thing. So it's the same old ignore the noise, right? But
that's right. These are the 6 month numbers.
Yeah.
So 6 month numbers are looking okay. Aussie market's up 6, Nasdaq is up 9, almost 10. The Dow's up 4. It'll
be really interesting because to your question before about we've talked a lot about inflation and the impact of interest rates and what's happening there in terms of the reversal of that. But over the course of the last few months, we've had the banking crisis in the US that has caused a few of these dips downwards, although fully acknowledging that interest rates were the cause of some of that in terms of what's happening. But it'd be interesting to see if you kind of remove those events from what actually happened. These numbers would be significantly better if you were just looking at the pure market reaction to the unwinding of the inflation story. So it's not that we can, it's just but I just thought it'd be interesting to see that.
Yeah. So where to from here, do you think, fellas?
More of the same from me. I
Yeah.
think it's just we're going to bounce around like a
It's continued choppiness,
yeah,
right?
correct.
Yeah.
Yeah.
Yeah, I think, I mean, the NASDAQ tells an interesting story up there, I think, in that, it's certainly far more sensitive to interest rate cycle and
Yes.
uncertainties around that. And you just look at the volatility there.
Yes.
And it's remiss not to talk about geopolitical risks as well at this point in time, which are having as much influence on markets as what interest rates are. So with all these sort of factors in the world, you can't help but feel that we've got choppiness in front of us. But I think pleasingly, some of the things that we'd want to see settle down are settling down,
Yeah, definitely.
which certainly helps, in terms of assessment and thought process around portfolios, I feel.
Yeah. Yes, agreed. Long-term, consistent, diversified approach,
Yep.
which is how we build our portfolios.
Yeah, absolutely. Yeah. And look, that choppiness also provides opportunities, right? So it's with a trend line upwards, that's the most important aspect.
Yeah.
So
Yeah.
yeah.
All right. Excellent. Any other comments we want to make?
We're getting close to our budget, which will be very interesting.
It's exciting.
It is for us.
we're gonna stay here and
We should just
do a
watch
budget
it.
party.
Why not?
I think we should.
I love the budget, so best night of the year. But it'd
I'll
be,
see you both the morning after.
Chris, come on.
but it
Really?
will. I think it will be really interesting. Sort of digressing a little bit from market numbers, because we've had this massive deficit in terms of government spending, and at some point in time, that reversal needs to take place. And whether or not it's now, with respect to the way in which our GDP numbers are sitting right now, you take out some government spending out of that might not be so pleasant. So I'm really fascinated to see what Jim Chalmers comes up with in the budget next month.
Yeah.
Yeah, it's going to be interesting to see the deficit, given that interest rates have gone up so sharply, how that's going to look. But I guess it all depends on the assumptions that you use going forward.
Generally, yeah, that's right. All right, very good. Thanks very much. Thanks, guys. That was great. We'll see you early next month, and we'll likely do a budget party, so we'll give a bit of an update from that as well. Thanks very much, everyone.
Okay, bye for now.
See you soon.